Hi, everybody. John O'Reilly from O'Reilly Wealth Advisors, and this is a quick video on how the markets and the funds that we use in our portfolio did in the year 2021. This is a screenshot from the quarterly market review, which is available at our blog at O'ReillyWealthAdvisors.com. And we're going to start with the U.S. stock market. And the index that the DFA uses in the preparation of this report was up about 25.7%. And if you look at the fund that we use to capture the U.S. stock market, DFQTX, which is up at the top right of the screen there, in 2021 was up 28.5%. So we beat the benchmark that DFA uses by about 2%. So now moving on is international developed stocks. So these are countries outside of the U.S. that are developed countries versus, say, emerging markets or even, say, third world countries. And as we look at the fund we use, DFIEX at the top right there, down here you see circled that in the year 2021 up 13.9%. So we did indeed beat that 12.62. Moving on to emerging market stocks, the index that DFA uses down 2.5%. And this was kind of a neat highlight here for us because the DFA fund that we use, DFCEX, was up 5.83% for the year 2021, which is kind of cool to be not only better, but having been positive versus being negative. That was a nice little plus there. And global real estate. Now, in our portfolios, we prefer to use a U.S. real estate fund versus global. We found that U.S. Typically does better than global, and the U.S. is such a large market. It's about 2/3 of the whole real estate market around the world anyway. So the global real estate index was up about 31%, but the U.S. real estate index was up about 38%. Down here you can see the Morningstar uses this index at 38.3, and the fund that we use, DFREX, to cover real estate in the U.S. was up 41.85%. So we beat the benchmark by a couple percentage points there. I just want to point out it's not easy. Most funds are not able to achieve their benchmark. So these are really good returns, your results you're seeing here. Now we're moving on to, I didn't repeat the slide here, but we're moving on to talk about bonds here. So as we go to bonds, the U.S. TIPS index was up 5.96%. The fund that we used there, DIPSX, was up 5.6%. So we were just slightly below the benchmark there. And then the U.S. aggregate bond index was down about 1.5%. And the fund that we used to cover aggregate bonds was minus 2.1%. So just slightly below the index for this year. So if you look at our blog, you'll see that overall, as you compare our global portfolio of 100% stocks compared to a blended index, we beat that soundly by 23% to 20.6%. So very good year. We're very happy with the market behavior, and we're extremely happy with our ability to capture the market behavior on behalf of our clients. So thanks a lot for listening, and have a fantastic 2022. Happy New Year. Bye-bye.